As per SEBI guidelines on categorization and rationalization of schemes issued in October 2017, mutual fund schemes are classified as equity schemes, debt schemes, hybrid schemes, solution-oriented schemes for retirement and children and other schemes, index funds and ETFs, and fund of funds. Under the equity category, large, mid, and small cap stocks have now been defined. The naming convention of the schemes, especially debt schemes, is based on the risk level of the underlying portfolio. For example, the erstwhile Credit Opportunity Fund is now called Credit Risk Fund. Balanced or hybrid funds are further categorized into Conservative Hybrid Fund, Balanced Hybrid Fund, and Aggressive Hybrid Fund. An equity scheme is a fund that primarily invests in equities and equity-related instruments, seeks long-term growth but could be volatile in the short term, and is suitable for investors with a higher risk appetite and longer investment horizon. The objective of an equity fund is generally to seek long-term capital appreciation. Equity funds may focus on certain sectors of the market or may have a specific investment style, such as investing in value or growth stocks. Equity fund categories as per SEBI guidelines include multi-cap fund, flexi-cap fund, large cap fund, large and mid-cap fund, mid-cap fund, small cap fund, dividend yield fund, value fund, contra fund, focused fund, sectoral, thematic fund, and ELSS. Sectoral funds invest in a particular sector of the economy, such as infrastructure, banking, technology, or pharmaceuticals. Since these funds focus on just one sector of the economy, they limit diversification and are thus riskier. Timing of investment into such funds is important because the performance of the sectors tends to be cyclical. Thematic funds select stocks of companies in industries that belong to a particular theme, such as infrastructure, service industries, PSUs, or MNCs. They are more diversified than sectoral funds and hence have lower risk than sectoral funds. Equity funds may be categorized based on the valuation parameters adopted in stock selection, such as growth funds, that identify momentum stocks expected to perform better than the market, and value funds that identify stocks currently undervalued but expected to perform well over time as the value is unlocked. Contra funds are equity mutual funds that take a contrarian view on the market, picking underperforming stocks and sectors at low price points with a view that they will perform in the long run. As per the SEBI guidelines on scheme categorization of mutual funds, a fund house can either offer a contra fund or a value fund, not both. ELSS invests at least 80% in stocks in accordance with the Equity-Linked Savings Scheme 2005, notified by the Ministry of Finance, and has a lock-in period of 3 years, which is the shortest amongst all other tax-saving options. A debt fund, also known as an income fund, is a fund that invests primarily in bonds or other debt securities. Debt funds invest in short and long-term securities issued by government, public financial institutions, and companies, including treasury bills, government securities, debentures, commercial paper, and certificates of deposit. Debt funds can be categorized based on the tenor of the securities held in the portfolio and/or on the basis of the issuers of the securities or their fund management strategies, such as short-term funds, medium-term funds, and long-term funds. Debt fund categories as per SEBI guidelines include overnight fund, liquid fund, ultra-short duration fund, low duration fund, money market fund, short duration fund, medium duration fund, medium to long duration fund, dynamic bond, corporate bond fund, credit risk fund, banking and PSU fund, gilt fund, and gilt fund with 10-year constant duration. Dynamic bond funds alter the tenor of the securities in the portfolio in line with expectations on interest rates.